Hey everyone, I'm delighted to be here to chat with you about the investment outlook as we sit here in the difficult times of 2020. It certainly has been a peculiar environment with the awful human toll created by the COVID-19 virus. From an investment point of view, it has also been an extremely trying period. 2020 has seen extreme volatility, both on the downside and on the upside. In reality, though, all in all, over the past 2 years, it's actually been a reasonable environment for investing. Unfortunately, we do not know the speed with which we reopen and exactly how the economy will perform once major economies have relaxed restrictions. Two things are clear, though. We will be dealing with relatively low interest rates and likely continued volatility in equity prices.
The good news has been we have seen significant action on the part of policyholders, and that involves both fiscal and monetary policy to really limit the damage created by a state-enforced shutdown. But before we go any further, let's just put the current environment in perspective. Over the course of the past 2 years, we actually have seen reasonable equity returns, whether that involves the S&P 500 or the S&P TSX, with the 500 really being the dominant equity market anywhere in the world. Sharp decline from the 23rd of March until the middle of February have certainly surprised all of us, but the rebound has been equally sharp and equally surprising. The good news is that staying the course has generally worked relatively well for investors. Now, unfortunately, the virus continues to rattle around the world. While in developed countries, we do seem to have shaped the curve somewhat down, the reality is many emerging markets are continuing to see a rise in the number of cases. Let's hope that this begins to level out further and actually decline over the course of the next coming months. The key point from an investment perspective, I think, is to remain invested, but really to consider ways to manage downside risks associated with portfolios. As we sit here today, we would be somewhat skewed towards equities and cash and less so to bonds. While there are clearly risks in equities and bonds, we believe there are higher risks on the bond side than there are on the equity side. Despite strong returns off the bottom, we need to stick to relatively low and modest risk equities rather than becoming too aggressive at this stage. Why aren't we more positive? Well, the reality is that valuations remain extremely high and are predicated on a belief that the rebound in economic activity will be sharp and V-shaped. We aren't exactly sure of the speed of the rebound, but the reality is the economy will likely carry the scars of the shutdown for an extended period of time. From our perspective, winning strategies still remain in quality and low volatility equities. This effectively means skewing towards better quality companies where the share prices are less volatile. I certainly know in the rebound over the course of the past week or two, there have been occasions where we've seen large moves in cyclical stocks and in value stocks which have performed very poorly over an extended period of time. We believe these are false rallies, and it is important to stick with higher quality businesses with better balance sheets, and also companies with less volatility. I would remind everybody that when one focuses on high volatility stocks, that volatility cuts both ways. Works well in good times, but can be extremely painful in corrections. So what do we mean by quality and low volatility? From a quality point of view, we believe the important features are to focus on companies with high levels of profitability, so high returns on equity. We also prefer companies that do not require significant capital reinvestment to maintain their level of activity. We also like significant operating cash flow. Quality businesses effectively steer you away from companies which ultimately will have more risk. On the low volatility side, this is another way to stay away from high-risk entities. More stable stock prices are generally a reflection of more stable business models, and they tend to be less correlated to the broader market, which certainly in an environment where the market becomes range-bound will prove to be beneficial. From our point of view, it is extremely important that we remain well diversified. This has been proven to be a winner through the test of time. Despite strong returns, it is important we do not chase equities that have a lot of risk or torque to the economic recovery. From our perspective, a long-term financial plan is still the basis of successful investing. With that, I wish you all safe and a healthy remainder of the year.